This is going to be a special edition video. And guys, I have never done this before. What you can expect. First off, I'm going to post the entire members-only charts and market analysis video from April 15th, today, when I'm posting this video. After I got done creating that video for my members, I realized that so many people need to have the information that is in that video. So I probably won't do this very often, maybe once a year at the most. I've never done it before, but you guys need this information. But I also want you to understand what you're missing by not being a member, not a subscriber, but a member to this channel, okay? So watch the charts and market analysis video, and that's just the charts and market analysis video. There's another video that I'm not going to post. You have to become a member to get access to it. But I think after watching this video, you're going to want even more information from me, okay? Then I'm going to explain my personal risk management system. So after the charts and market analysis video, then there'll be another video section that will explain my personal risk management system that I created for myself. And it took me over 20 years to create this thing, guys. And back in 2017, it finally came together. And then after I worked with it for a couple months, I realized that I could help a lot of people by sharing that information. So I built a business around it. And I have several different ways that I disseminate and share that information. I'm going to explain to you the risk management system. And then I'm going to show you how to get access to my risk management system data, okay? So these are the things that you can expect in this video. First, there's going to be the entire unedited, full-length charts and market analysis video from April 15th. Then I will explain my personal risk management system, and then I will show you how to get access to my risk management system data. This is the exact system that I use to manage the risk within my investments, and I'm going to show you how to get access to this. So please, guys, make sure you watch this entire video, and you're probably going to want to watch it several times. And don't forget to subscribe to this channel. This is going to be the Simple Market Signals Charts and Market Analysis video for April 15th, 2023. And let's start off with the Dow Jones Industrial Average, a quick review of the chart format. These are weekly candlesticks of whatever we're looking at. The charts still right now go back to 2021 because of the volatility we've had in the market. I'm leaving 2021 in there so we can get some perspective. And the green line is the 40-week moving average, which, as a reminder, has nothing to do with the Simple Market Signals proprietary model. It's just a very standard, probably the most basic technical tool that people use on charts, so we do leave it in there for reference, visual reference, and talking point purposes. So to start off with, the Dow Jones Industrial Average up 1.20% this week, and the Dow is up 223 so far year to date. And of course, that's for calendar year 2023. And we can see here kind of a sideways trading action. We're going to see this in a lot of the charts here, guys, really going back to February, March of 2022, sometimes to May. But the point is, over the last, if we look at where we're trading at right now and go to the left, there's a lot of things that, a lot of investments, small, medium, large growth value, you're going to see as we go through. A lot of these things are trading where they were about a year ago, and in some cases several years ago. If we go further to the left here, we can see that where we're trading at right now is about where we were in February, March of March, April of 2021. So the point is, we haven't made a lot of progress over the last couple of years, but this becomes kind of a base building format, all right? And at least we're not falling any longer for now, all right? And from my experience, the longer you trade in a sideways range, and the longer you trade off of a bottom, the less likely it is that you revisit that bottom, all right? So much to the dismay of all of these people that are out there saying the market's going to crash, most of them don't have a lot of market experience from what I can tell. So please be careful, guys, with the people that think that they can predict the future. No one can predict the future with any degree of accuracy. They may get lucky once in a while, and then they think they're, Nostradamus, and all of a sudden they're trying to tell you, that they know what the future is going to look like, and they're reading the tea leaves and reading economic information, and they want to make you believe that they know all of the economic inputs that can affect something. And it's if you think about all of the different, and guys, this is I'm just going to spend a minute on this, but it's so important for you to understand this. The stock market and the economy are not the same thing, right? And the more you pay attention and try to figure out economic pieces of data and try to extrapolate that into the future and try to expect that the stock market is going to react, quote unquote, rationally based on what you think the economic information is telling you, the more confused you're going to be. If you pay attention to the stock market, if you pay attention to the simple market signals, proprietary model signals, if you pay attention to the technical work I do, you're going to be a lot less confused, and you'll have a lot better results in the stock market, okay? Stock market and the economy are not the same thing. All right, so let's move on to the S&P 500. S&P 500 up 79 basis points this week, just shy of 1%. But look at this year to date. S&P 500 is positive 7.77%. Pretty hard to believe, when you think about it. But sure enough, S&P 500 just so far for calendar year 2023 up 7.77%. And keep in mind that the long-term average, going clear back to like 1970 on the S&P 500, is about 10% a year. So, we're on target for, potentially kind of an average year if this trend continues. And we only need to pick up a couple more percentage points, and we're going to have that quote-unquote average 10% per year. And then, of course, this return doesn't include any dividends inside of the S&P 500, which generally run, I haven't checked it recently, but generally over the long haul running about 2% per year on the dividends. So when you look at total return, the NAV, net asset value, right, price change plus dividends, we could be looking at a fairly average 10% year, and we won't even need a whole lot of upside between now and the end of the year to accomplish that on the S&P 500. But nicely trading above the 40-week moving average. Some sideways trading here. We'll talk about this more towards the tail end of the video, where we get into some more technical work on the S&P 500 and a little on the triple Qs. But from a technical standpoint, guys, not looking too bad. And of course, make sure you watch the video newsletter for this week, and you'll see that the proprietary model signals are accurately reflecting what is happening because they're based on the stock market, right? And keep in mind, I created the signals, the model for myself, and then I'm sharing that data with you. And my goal, of course, for myself when I created that model was to be able to identify the mode that the market was operating in. Were we operating in an upwardly mobile mode like, in 2021, right, where most of the signals, as we know, were green, no red signals at all. And yet so many people, the market's too high, and I knew, people were shorting the market and getting themselves in a lot of trouble trying to fight the market. Guys, don't fight the market. One other quick thing here. One of the things, and I think it's almost kind of funny if it wasn't so sad, that I've been hearing lately is the market's got it wrong. The market's got it wrong. Again, these are very, very economic-focused, egotistical individuals that think they know what the stock market should be doing. Guys, the stock market, it is what it is, all right? Whatever it is, it is. You and I fighting the market is not going to change anything, all right? So I would encourage you to put your ego aside, put your opinions aside, and just whatever the stock market is doing, it's doing, okay? We can't fight it and trying to think, well, I know it's too high, or I know it's too low, or I know it's this. Yeah, if you're going to do that, you're going to end up over time probably being pretty miserable and having miserable results. You're going to get yourself on the wrong side of a trade, the wrong side of the market, and you're going to stubbornly sit there and short the market and or whatever, and you're going to be in a lot of trouble. All right, you got to learn to flow with the market, and whatever it's doing, it's doing. All right, and again, this is where I took a step back years ago. Even though I've got a extremely detailed financial background, 4 securities licenses, 5 industry designations, life, accident, and health license. I had all of that at the peak of my career when I was running money. All of those simultaneously, by the way, took me a lot of years to get all of those securities licenses, insurance license, all of the different securities designations that I had on top of the licenses, and of course the CE, the continuing education, was brutal when you have that many designations and licenses. It was pretty brutal to keep up on top of all that. But the point is, guys, even even with all of that, right? And so I was indoctrinated into the normal way of thinking about the market, but I just kept looking at all the people that were struggling, right, by, in the whole industry, basically. And even, you watch people on the TV, right? They're so confused right now about the economy and the stock market. Well, it's because it's not the same thing. And I've learned to realize years and years ago that you cannot take a look at economic data and make any prediction and do it over and over again. It cannot be replicated over and over again as to what the outcome of the stock market is going to be, right? You can have a hypothesis as to what you think it's going to be, and from time to time that hypothesis may line up. But the only thing that I have found that's worked is having a market-based, rules-based system like simple market signals, and it's the only thing I've ever seen that's out there, which is why I had to create it. I went looking for something that I could acquire, I could buy, I could be a part of, that would give me the information I need, and it didn't exist, so I had to create it. But by paying attention to the stock market itself and the internal market metrics and things that are repeatable, right? When I realized that when the market's going up, there's internal data that is present. When the market's going sideways, there's things that are present. When the market's going down, there's things that are present and measurable, like a person's vital signs, blood pressure, temperature, things like that. And once I realized that these things, virtually every single time the market was going up, the market had a certain, internal market metric to it. Sideways, same thing. Down, same thing. Then I realized, all right, now I've got something. And anytime I see those internal market metrics, I can have a realistic expectation as to the health of the stock market, just like looking at your vital signs, okay? Doesn't mean that the health of that individual can't change, but if somebody's blood pressure is good, if their body temperature is good, if their breathing is a certain way, they're probably okay, right? They're probably going to live throughout the day. Maybe not, accidents can happen, but the point is, guys, by focusing and not getting distracted by the shiny object in this case is all of the economic data points, which, by the way, are lagging, and even as the Fed will say, they have long and variable lags. Well, how can you use some data point? Forgive me for being on a rant, but it's so important for you guys to understand this, right? If you want to be successful in an investor, you want to be part of the investor class. You want to really make money with money, which is a really difficult skill set, guys. Making money with money is really, really hard, okay? And that's what we're doing here. We're investing money and trying to make money on our invested money. And I have found it, for me, it was virtually impossible to try to use economic data to do that. The only way what I have found is by using the stock market data, focusing on what I'm actually investing in, S&P 500, triple Qs, individual stocks, whatever. But you start with the stock market first, because the single biggest risk that most investors face is overall market risk. It's market risk. 80 to 90% of all stocks over time are going to go in the same general direction as the stock market. So get the stock market right first, and then it makes the rest of the job so much easier, okay? So sorry about the rant, but it's just so important, guys, that you understand this, all right? So again, S&P 500 trading above its long-term moving average. Long-term moving average starting to turn up. Pretty average volume over the last few weeks. Had a nice volume spike to the upside here about 5 weeks ago, so that was really nice. But up 777, right? 777. Kind of like the airplane, right? The Boeing airplane. Up 7.77% this week. Year to date, and up 79 basis points for the week. So a very nice week. Let's move on to the RSP, which of course is an equal-weighted version of the S&P 500, an ETF from Invesco, and they take all 500 components of the S&P 500, give them the same weighting, where of course the S&P 500 itself is capitalization weighted. RSP up 1.09% this week and up 292 year to date. Now I'm going to back up here, guys, and this is why it's so important to pay attention to these things. You look at the year-to-date performance of the S&P 500 itself, the standard construct, up 7.77%. And then the equal weighted up 292, we can draw some conclusions right there that the large caps, right, Microsoft, Apple, Google, Amazon, things like that, the larger companies in the index that make up a larger percentage of the index, just by looking at these two data points, right, year-to-date RSP up 292, regular S&P up 777, well, the conclusion we can draw is the large caps must be outperforming, the small and mid caps, or especially there's about 30% mid caps. So I misspoke when I said small, but the point is the smaller capitalization companies are not keeping up with the larger mega cap multinationals right now, and that's why we're seeing that differential. All right, there's times that the RSP, the equal weighted version, will outperform. There's over the last week it outperformed, right, but by 30 basis points. But year to date, the equal-weighted version is up less than half of what the standard construct is. So what you're going to find is, in most cases, in a bullish environment, you're going to be better off, at least from my observation. You're going to be better off in the standard construct S&P 500 than the RSP during a more bullish environment. Okay, so just something to think about, something to look at. All right, let's move on to the triple Qs. Triple Qs, of course, high beta, tech-heavy, no finance stocks in the triple Qs. And what you're going to see is the weeks where finance, like banking stocks, did pretty well this week and are reporting earnings right now. So the triple Qs only up 16 basis points this week, where a lot of other things like the S&P 500 did much better. But look at this, up almost 20% just year to date. Now it was at pretty much at its low point at the beginning of the year, right? So that kind of lines up to where on a calendar year basis it really helps the triple Qs out because it was starting at one of its the lowest points of the downturn, but still up 19.82% so far for calendar year 2023. Not a bad start to the year, up 16 basis points for the week. And as I've pointed out week after week, this is one of these leading indicators, if you will, that we want to look at. It has nothing to do with the proprietary model, but just from a technical standpoint, we want to see in most cases the triple Qs outperforming the S&P 500, because if the triple Qs are not outperforming the S&P 500, we generally don't have a really healthy market. Okay, I mean, it's just the way it is. You can do your own technical work on this to see that, corroborate what I'm saying, but I'm telling you, I've looked at this time and time again, and the most bullish environments over time will have the triple Qs outperforming the S&P 500. Next, let's take a look at the MDY. The MDY is an ETF that tracks the S&P 400 mid-cap index here in the U.S., and the MDY up 1.74% this week, and year-to-date up 2.87%. And we can see it's, kind of trading about where it was about a year ago, right? End of April of 2022. And then if we move to the left, MDY trading about where it was during Q1 of 2021, right? So we can kind of look at this as a wide base. That could be a good thing. Only time will tell. MDY back above its slightly upwardly trending 40-week moving average after spending last week below that 40-week moving average. And, of course, on the MDY and the IWM, which we'll look at next, the small cap, we saw a big drop about 6 weeks ago in the pricing of those indices. Those things were down quite a bit, and this was due to the exposure to financials. Keep in mind that the small and regional banks, remember we had that, air quotes, the banking crisis, if you will, a few weeks ago, where a few banks went bankrupt here in the United States. The Fed had to step in and backstop some stuff, and that caused a pretty big drop in the shares of these publicly traded small and regional banks. And of course, these are the indices, right? The S&P 400 index and the Russell 2000. Those are the two indices, the indices where you're going to see a lot of exposure to those financials, those small and regional banks. So that's why we saw the big drop in these particular ETFs and these indices because we had a pretty high financial exposure to that area. All right, so point is, after that one big drop, a little bit of follow through the following week, we're seeing some stabilization, some stability here. We're not continuing to fall, so that's a good thing. We'll have to keep an eye on this area. Hopefully, the damage, the worst of the drop in the small and regional bank pricing is behind us, but we'll have to keep an eye on that. But that's why we saw this big drop, and that's why we're seeing the MDY trading around its 40-week moving average. And the IWM is still trading right now below its 40-week moving average after that big drop 2 weeks ago, or 6 weeks ago, excuse me. But again, as you can see here, we had that drop and then further selling the next week, and then we've seen stability since. But the IWM, which of course is an ETF that tracks the Russell 2000 Small Cap Index, is trading underneath its 40-week moving average. IWM up 1.51% this week and up 161 year to date. All right, so we will have to keep an eye on the small and mid-cap space, but for now, it looks like the selling has stopped, and we're seeing some stability in these areas. So fingers crossed that continues. Let's move on to the SPYG. The SPYG, of course, is an ETF that tracks the S&P 500 Growth Index. And, of course, it's S&P 500 stocks, but only those ones that qualify for the growthy part of the S&P 500. SPYG up 0.70% this week. In year-to-date, up 10.76. So pretty nice start to the year. Decent week this last week, trading above its 40-week moving average. And we've had 4 weeks in a row now, right? 4 positive weeks in a row actually 5 positive weeks in a row on the SPYG, but 4 of those have been above its 40-week moving average, which is starting to turn slightly up. So all of this bodes quite well. And as I've told you in the past, based on my experience, you generally want to see growth outperform value. That's when you see the market at its healthiest. A lot of people, value is going to lead. Guys, I just don't see it that way. I could be wrong, but if we look here, and let's take a look at the SPYV, right? Year to date, it's up 562. The SPYG up 1076. Now, in a downturn, sure, value outperforms growth on a relative basis. Both of them lose money generally, but you lose a lot more on the growthy side of things. But when the market is going up, right, like 2021, you generally are going to make more money in growth than you will value. All right, so it's up to you, but these are just my observations. You'll have more volatility in growth. You'll have more downside in growth when the market corrects. But on the upside, when the market is going up, when you have a tailwind, generally you can expect to make more money in growth. Things like the SPYG, the triple Qs, right? The tech sector, things like that. All right, SPYV, the value, the sister product, right? The S&P 500 Value Index ETF, SPYV. Up 89 basis points this week, of 562 year to date. And as we can see here, this thing has been trading since November. It's been trading above its 40-week moving average. We've pulled back to the 40-week moving average, but we have had no weekly closes below the 40-week moving average on the SPYV since clear back in November. All right, so it shows the stability. And even back right here, I pointed out, you may remember if you've been with me for a while, that the SPYV was trading at its all-time high. And I pointed out then that, back in January, February, I pointed out then, guys, it's like, well, how can we have a really horrible situation when we've got indices like this and ETFs trading at their all-time high, right? I mean, if things were really bad in the stock market, value would be going down as well. It may not be going down as much as growth, but again, pay attention to the stock market itself and don't fall into that trap of the stock market's got it wrong. Guys, it is what it is. You may not like it. It may not make a lot of sense. You may not agree with it, but don't fight it, right? The stock market is what we invest in. We don't invest in the economy. We don't own shares of the economy, right? And so, if we can understand that and we can avoid that shiny object mentality, right? The shiny object being all this economic data points and, all these people that are so smart that they think they know what the economy is telling us that the stock market should be doing. Well, yeah, it just doesn't work, guys. Don't fight it, right? The stock market is what it is, and whatever it is doing, it's doing. All right, that's just the way it is. And right now, market is stabilizing to going up. I am not saying it's a super bullish environment. I am not saying it's comfortable, but it is what it is. All right, let's move on to the EEM. The EEM, of course, is an ETF that tracks the emerging markets. The EEM, after pulling back for about 6 weeks, is going slightly up here. EEM up 84 basis points this past week, 0.84%. Year to date, the EEM, excuse me, I can't get my words together today, up 4.80%, so a decent start to the year from a calendar year standpoint. And the EEM, 4 weeks above its 40-week moving average after pulling back and closing below it for a couple of weeks. Fairly normal volume, falling off a little bit here, but at least we're back above that long-term moving average on the EEM after spending well over a year, right, from midpoint of 2021 until the end of 2022. EEM traded below its 40-week moving average, and as I pointed out in the past, as you know, if you remember when you were a kid, right, your parents, nothing good happens after midnight. Well, you know, if you heard something like that, 11 o'clock, 10 o'clock, whatever the time frame was, well, you know, you can kind of keep in the back of your mind just as a rule of thumb. Nothing good happens underneath the long-term moving average. In this case, the 40-week, and so the fact that the EEM is kind of stabilized and is back above its 40-week moving average is a good thing. I'm not saying invest there; that's up to you. But at least it's trading above its 40-week moving average. Now the FXI, which has a tendency to be even a little bit more volatile, but not dissimilar. Of course, the FXI tracks large caps in China. And we can see here that we had a couple of decent weeks, pulled it back above the 40-week moving average right after it fell below it here a few weeks ago. But FXI down for the last 2 weeks in a row, down 1.98% this past week, and the FXI is up 1.45% year to date, but still trading above its 40-week moving average. But you can see that 40-week moving average on the FXI is still kind of downtrending, right? So it's not really a good thing, but at least the volume on these last 2 weeks where the market has been falling, at least the volume has been kind of lower volume, right? So that's a good thing. We'll take it. We'll take what we can get here. But as I pointed out time after time, guys, just be careful. Anytime you're stepping outside of, say, the United States, right? And again, I've got people from all over the world watching these videos, but just understand, unless, whatever your country's currency is, but S&P 500, obviously these are companies that are listed in the United States, so it's U.S. dollar denominated investments. When you start to buy investments that are denominated in another currency, you're taking on additional currency risk. You have to kind of think about that. You're taking on country risk. You're taking on political risk. And in some cases, you're taking on, the risk of, say, a communistic country versus a more freely trading capitalistic country. All right, so just keep all of these things in mind. A lot of people don't think about this when they invest, and we have to think about all of that. Okay, so FXI, obviously, these are companies domiciled in China, and do, if you're going to invest in these areas, do your homework and don't let these things get away from you. Right, if they start to trade below their long-term moving average, you may want to trim back or eliminate your position in anything, but especially in things like this where there's a lot of things politically that are out of your control. Now, let's go back to the S&P 500 and let's do some technical work here, kind of see what the S&P 500 is telling us. And what we can see here is that the S&P 500 continues to trade above its 2022 downtrend line. So as you can see here, I drew a downtrend line on the wicks of the candles, right? So the very tippy top, if you will, of this downtrend that we had in place during calendar year 2022. And we can see here, 2023, we broke above it and then pulled back to it. And then over the last 1, 2, 3, 4, 5 weeks, right, we've climbed back above it, and we're trading about as high as we have during calendar year 2023, but nicely above this downtrend line, right? So all of this, from a technical standpoint, is a good thing, and we want to continue to see this. Now, conversely, right, if we roll over and start to trade below that downtrend line, which right now is just above 3,800, where that's lining up, that would not be a good thing. All right, so something to keep in mind there. But for now, we continue to trade above that. Now, where we closed this week, 4137.64 on the S&P 500. It's small, but it's right there where my cursor is circling, 4137.64 on the S&P 500. Not too far from that 4,200 level. Well, 4,200, guys, this is a really, really important major overhead resistance area on the S&P 500. And what we can see if we look to the left is that the last time we had any weekly close above 4,200 on the S&P 500, it was back here in August. We had 2 weeks, and then it failed. And then to get another week, right, we have to go clear back to April. So it's been basically a year minus these 2 weeks since it's been a year since we've had 3 weeks in a row, right? We know that. We have to go back here. That the S&P 500 on a weekly closing basis closed above 4,200. So this 4,200 level, if we continue to see the market go up, if earnings don't come over the next few weeks, as companies announce earnings, if they're quote unquote less bad, right? A lot of times things don't have to be good; they just have to be less bad than what people anticipated them being, and the market can rally. So, if earnings come in okay, things aren't as bad as what people thought they were going to be. If the if the comments from the companies that are announcing earnings are saying, I think we're going to be okay. We've cut expenses, laid people off, and we're going to be okay. We're looking forward to a better 2024, 2025. If there's some positive conversation that along with the earnings announcement, then I think it's very possible the market will continue to go up. And if that's the case, then we could breach to the upside this 4,200 level over the next few weeks, and that of course would be extremely that would be extremely good, all right, and it would bode quite well for the overall market. But for right now, we need to understand that this 4,200 level, I don't think it's going to be from a technical standpoint. This is a very, very thick, because we can see where we pulled back to, stopped right there in March, bounced, and then failed below it. I mean, that was we hit it, bounced, and then failed. And then we had a failed rally attempt here in August of last year. The point is, this 4,200 level, guys, very, very important. If we can get above that and stay above it, that is a really, really good sign. However, I think we should at least expect the possibility that, of something like this where we fail at least for a few weeks. We struggle to get through that 4,200 level. All right, so we'll have to keep an eye on that. Now, let's take basically that same chart, add a few more lines to it, and so we've got 4,200, 4,000, and 3,800. And what we can see here is that the bulk of the trading in the S&P 500 since the end of April of last year, right, April of 2022, the bulk of the trading, look at this, now we've had some trading, right, out, just a little bit, as we talked about just a minute ago, above 4,200. We've had a little bit below 3,800, but the majority of all of the trading in the S&P 500 for basically this last year has been between 3,800 and 4,200. So we've got this, really nice sideways base at 4,000 plus or minus 200 points that's being built on the S&P 500. And this can be a very, very positive thing, right? We're building this nice sideways foundation. As long as we stay above this 3,800 level, there's really not a lot to worry about. Now, again, from a simple market signals proprietary model signal standpoint, I want you to understand that if we do pull back to this 3,800, expect some signal changes, right? If we continue to waffle and go back and forth, there'll be some signal changes for sure. I want you to expect that. But from a purely technical standpoint, if we can stay above 3,800, well, all these people, the market's going to crash, the market's going to, I'm still seeing, people, and they're generally younger, they don't have experience, they were probably in elementary or junior high school when, the 2003 downturn happened, right? They just don't have the life experience, the market experience, and the knowledge that they think they have. And they're making these, 80% market crash, predictions. Guys, if we stay above 3,800, how is that even possible? It's not. Now, maybe we'll go below 3,800. I don't know. But as we can see here, there hasn't been any trading below 3,800 on a weekly closing basis since back in basically the first week in November, right? And we only had a few weeks in September, October where we closed below that. So, when we just look at the data, right, and look at the evidence, we've, in this entire downturn, there's only been a small amount of trading, weekly closes below 3,800, right? So that becomes a really nice floor, right? And we can see even recently we pulled back to it, bounced off of it, and the last 1, 2, 3, 4, 5 weeks been trading above it. But 4,200 is going to give us fits on the upside. So 3,800 to 4,200, sideways base, that's our trading range. As long as we stay within that range, from a technical standpoint, not a lot to worry about. All right, now let's move down 100 points at a time. You've heard me talk in the past that round numbers, and it is true, round numbers have a tendency to, anything ending in a zero or especially a double zero, just for whatever reason, especially in the major indices, but even on stocks, those numbers ending in the double zeros have a tendency to be areas where there's a lot of trading. And 4,100 is no exception. Now, the S&P 500 has closed above 4,100 now 3 weeks in a row, right? Just barely closed above it 2 weeks, and then this week again, 4137.64, so less than 38 points above it. But hey, we've got 3 weeks in a row where we've now closed above 4,100, and then we had one other week back here. So we now have 4 weeks in calendar year 2023 that have closed above 4,100. And then if we go back to May of last year, there's been a total of 10 weekly closes. Not a lot, but you can see again where, most of the trading, right, 3,900, and we'll talk about this, but 3,900 to 4,100. But then when you move those ranges out 100 points on each side, you can see that that 3,800 to 4,200 trading range has been super important. Now let's again go to the midpoint here. The midpoint of this range that I'm identifying as 4,000, and when we drop down another 100 points to this 4,000 level, we can see, and let's just go back to the end of August, we can see 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. 11 weekly closes above 4,000 since the end of August, beginning of September, right? But look at this, right? 8 of these weekly closes above 4,000 have occurred right here in 2023, and 3 of those, of course, in a row right here. So we're seeing more and more weekly closes above 4,000, 3 in a row above 4,100, right? And now let's drop down, and we're going to go to a daily chart. Now, this is a daily chart of the S&P 500 because I want you to see just even on a daily basis this 3,900 level. Look at this, right? It just, especially the closes. Right, we closing above it, closing below it, closing above it, closing below it. 3,900 has been super important, and it's acted as a major overhead, a support and resistance. Right, when we're above it, it's overhead. It's support. When we're below it, it's overhead resistance. So you can clearly see this 3,900 level even on a daily candlestick basis. Super important. And during this entire, beginning of the year, right, we started off below 3,900, got above it, and it acted as support. We had a few days where we closed here in March where we closed below 3,900, but we got right back to business, got back above it, and look at that. Since those few days, we've been above that 3,900 level. So all of this is pointing to an improving stock market trading, right? I'm not talking about economics. I'm talking about the market itself. All right, now, if we roll back over, if, things do deteriorate economically as well as, of course, in the stock market, and earnings don't come in near as good as what people think, and, and the stock market starts to get away from us, PEs are contracting, earnings are falling. Well, if we break below that 3,800 level, right, 3,900 and then 3,800, then we will, likely go back and retest those lows in October down around 3,500. And, and I doubt if that's the case, I doubt if that would hold. And so then we should expect 3,200 to 3,500. There's a lot of trading in that range from the tail end of 2019 through 2020. Of course, we had the COVID downturn and then the very quick recovery because of all the stimulus money that was thrown at the economy, both here in the U.S. and abroad. But this 3,200 to 3,500 range, guys, it's still not out of the question. The longer we stay above that 3,900 level, I think the less likely it is that we go down and visit this, but it's still possible, okay? It's still possible. So I want you to understand what the downside is if these other levels that we just talked about fail. So it's still possible we could see, 3,200, even below on the S&P 500, but as time goes on, I think it's less and less likely. All right, so now let's move on to the triple Qs here. And, of course, this is very similar to the chart that we looked at a few minutes ago, downtrend line on the triple Qs instead of the S&P 500. You can see I drew it on the wicks of those candles. And you can see now we've had 12 weeks in a row here where the triple Qs have closed above that 2022 downtrend line. So we can clearly see, right? We're in an uptrend. We're not in a downtrend on the triple Qs and on the rest of the market, right? We're trading above these downtrend lines. So at least for now, guys, we're in an uptrend, and things are from a market standpoint improving. Now, the triple Qs, of course, only up 16 basis points this week, so it was one of the worst performing on a relative basis areas of the overall stock market this week. So we'll have to see, is that telling us something? But so far, again, I know we've already looked at this, but I just want to remind you, up almost 20% year to date, up 19.82% so far for the year. But the lack of financials in the triple Qs hurt it this week. But of course, it didn't experience the same level of damage 6 weeks ago when the overall market went down because of the banking crisis. And so we just didn't see the triple Qs get hit near as hard because there's no financials in the triple Qs, right? It just doesn't have that same level of exposure. So it avoided the damage 6 weeks ago, but it really didn't participate to the upside with a lot of the banks, the larger banks, doing quite well this past week. And let's take a little long-term chart of and this is a monthly candlestick now, so each candlestick on this chart represents 1 month. We're going clear back to 2007, but what this is the triple Qs with the long-term trend line drawn at the lows of the bear market in 2009 and the quick mini bear in 2020 because of COVID. And we can see, just like clockwork, guys, we pulled right down at the end of 2022 for the last few months. We pulled right down to this trend line, but stayed above it. All right, so it just shows how this trend line stuff works. It's just so amazing, right? Even after I've been doing this for so long, it still amazes me how well this stuff works. So as long as we stay above on the triple Qs, as long as we stay above this trend line, we're still in a long-term uptrend, right? We got pretty far above it. You look at the gap here, right? We got way above it and pulled back to it, but we're still above it. So we have a long-term uptrend on the triple Qs. That is intact, but if something really crazy happens and we roll over and start trading below about 280 or so, you can see that we're going to break below that long-term uptrend on the triple Qs, and that would not be good not only for the Qs, but it probably wouldn't bode well for the overall market. Let's take a look at the VIX. The VIX, as you might imagine, the volatility index fell this week, fell 7.23%, and closed at look at this, guys, this weekly close, right? We played around here in January, kind of dipped down to it, but from a weekly closing basis, this was the lowest weekly close at 17.07, and we closed at the lows of the weeks. The high was 20.05, low 17.07. If we move to the left, we can see that we have to go clear back to 2021 to see a weekly close, and really we have to go back to October, November of 2021 to see a weekly close on the VIX as low as where the VIX closed this week. Okay, so there's two ways to look at this. Of course, people, well, everybody's getting too complacent. That's possible. Maybe we're toward the low end, and maybe we roll over here, and that would line up with a lot of the technical work, the 4,200 level on the S&P 500. So that is completely possible and perhaps plausible, but it also shows you from a just a fear standpoint. A lot of people look at the VIX as a fear index, and again, it has nothing to do with the model, but it's just something to understand, right? It's has a lot to do with the psychology of the investors in the overall market, but people are getting comfortable with where things are at is one way to look at this, but perhaps too complacent. And if the market does start to roll over, we should expect a spike in the VIX over the next few weeks, but that's if the market does start to roll over. But for right now, right, we'll take it. We had a nice nice upward movement in the overall stock market, downward movement in the VIX, and again, we're trading at the lowest levels on the VIX that we've seen in well over a year. Did you know that market risk is the single biggest risk most investors face? And yet most people don't have a reliable, repeatable way of determining market risk. Traditional technical analysis helps, but it falls short. Market risk is non-diversifiable risk. Let me repeat that. Market risk is non-diversifiable risk. Market risk cannot be diversified away. You need a market-based system that is reliable, repeatable, and free of personal bias to help you understand what mode, market risk level, the market is operating in at all times. Once you understand what mode the market is in, you can then position your investments correctly to match the market. From here forward, staying in sync with the stock market will be one of the major keys to successful investing. I spent over 20 years developing a proprietary system that helps me understand what mode the market is operating in. I call my proprietary system Simple Market Signals. I developed Simple Market Signals for myself. I am now making my proprietary model signals available to you. The potential benefits, if used properly, include increased upside capture, decreased downside capture, improved risk-return profile, and the ability to sidestep major market downturns. Simple Market Signals is stock market-based, rules-based, and based on our proprietary multi-factor model. Simple Market Signals does not include opinions, hunches, guesswork, or conspiracy theory. We stick to market-based facts. Who is Simple Market Signals for? It's for equity investors. Simple Market Signals is perfect for individual investors, whether you're novice or experienced, as well as financial industry professionals, including financial advisors, money managers. You run an RIA perhaps, you're a hedge fund manager, or any other financial industry professional. Simple Market Signals is right for you. And it's right for anybody that wants to employ both offense and defense with respect to their investments, and it's for anybody that wants an edge, wants an advantage when it comes to their investing and trading. Simple Market Signals works with any type of equity account, including 401ks, 403bs, IRAs, or any other equity-based retirement plan like a SEP, a Simple, or whatever you may have at work. And Simple Market Signals is, of course, perfect for non-retirement accounts like a margin account or a trading account, or however you refer to your non-qualified, your taxable trading account. Simple Market Signals works with any type of investment vehicle, including mutual funds, ETFs, stocks, or options. Who is this available to? Any adult who has access to YouTube around the world. Who is this not for? It's not for those who don't invest in equities, right? This is an equity-based system. So if you only invest in crypto or commodities like gold, silver, copper, oil, corn, soybeans, or you only invest in art, automobiles, collectibles, diamonds, Simple Market Signals is just not going to help you unless you're an equity investor. There's two major components to the Simple Market Signals proprietary model. There's the risk mode, the market risk level signal, and then there's the general trend indicator. Let's start off with the Simple Market Signals risk signals. The Simple Market Signals risk signals, the market mode signals, are simply green, yellow, or red. When the signal is green, this is when you're going to have your easiest, lowest risk profits, and this is when the market is generally in an upward market mode. When the signal is yellow, this is when we have a soft market, and the market is generally sideways to slightly up or down in a yellow signal environment. However, the yellow signal can also be that transition signal between a green and red signal if the market is really starting to sell off. And what you're going to find is when the market mode or risk signal, right, you can refer to it either way, but when the market mode signal is red, the worst losses, including bear markets, are going to happen in a red signal environment. So when the signal is red, the market is generally in a downward mode. Next, let's take a look at the general trend indicator. The general trend indicator measures the trend of the stock market based on our proprietary formula. The signal is either positive or negative. When it's positive, we're in a upward general stock market trend. When the signal is negative, we're in a downward general stock market trend. And to give you a little backstory on the general trend indicator, there's over 7 years of research behind the general trend indicator. And this is real world testing and research. I tested numerous time frames to figure out the optimal time frame because I wanted something that stayed positive during the bulk of most uptrends, but was negative during the bulk of most downtrends. So it took me 7 years of real-world tweaking, testing, and research to determine the optimal time frame for the general trend indicator. Now let's put it all together. Now what we're looking at are the signal combinations. So the first one, the green, remember the risk signals, the market mode signals are green, yellow, and red. So the green signal is what's on the left, and then what is just behind the slash, right, the forward slash, is the general trend indicator signal. So when the signal combination is green positive, what that means is we're looking at a green market mode, green risk signal, and then the positive is the general trend indicator. So green positive, that is by far the best signal combination within the model. And what you'll find is that over time, most all of your profits in the stock market will come under a green positive signal combination. The next best, right, the second best signal combination within the model is yellow positive. Again, that's a yellow risk or market mode signal with a positive general trend indicator. Now, under the yellow risk signal, we can also have a negative general trend indicator. So when the combination is yellow negative, that is a more serious yellow signal. And then the worst signal combination is red negative. So we have a red risk signal with a negative general trend indicator, and that is the worst signal combination. Now there is one other signal combination. It is rare, right? The red positive. But when the market has sold off, like in a bear market, and is starting to rally, starting to, or at least trying to recover, we can get a red positive signal combination, but this is only seen after a major sell-off when the market is trying to rally or recover. Now let's take a quick look at a few market mode risk signal charts for the last few years. We're going to start off with 2018, and you can see here what I was talking about, that most of your upward progress in the stock market will be made in a green risk signal environment. The yellow signal is kind of a sideways to slightly up or down signal, as you see here. And then the red signal, right, this is just 2018. We'll look at a few more here in a second, but you can see the red signal here that we had in the latter part of 2018. And then moving on into 2019, we came into the year with a red signal, and then it went green, and you can see the progress that we make here. Yellow, correction, green, yellow, green, yellow, green. So you can see that most of the yellow signals go back into a green. The yellow is kind of a short pullback in a lot of cases, but as we saw here in 2018, and what you'll see also in 2020, is the yellow signal can be that transition signal between a green signal and then a red signal, as we see here with the COVID sell-off in February, March of 2020. And again, you know, as we see here, right, most of the upward progress in the stock market is going to be made in a green signal environment. So think about this, guys. As long as the signal is green, you can see there's just not a lot to worry about, right? And even most of these yellow signals, this is when we get that pullback, but it gives you confidence in knowing what the market is doing. Now let's take a look at a few charts for the general trend indicator. And just like with the risk signal, we're going to start off with 2018. You can see we came into the year with a positive signal, had kind of a chop here where we went back and forth between positive and negative for a little while in February and March. We had an outright negative signal and then went back into a positive. But you can see here, right, this sell-off that we had in Q4 of 2018, we've already looked at the fact that that risk signal went red, and you can see here that we would have had a negative general trend indicator signal as well. So as I've already shown you, when you get that red negative combination, that is by far the worst signal combination in the model, and most of the losses in the stock market, most of the big losses that you'll experience will come in that combination, right? Red negative. And then you can see here when the signal is positive, this is when you get the most upward progress in the stock market. And this takes us into 2020. Of course, we had the negative signal right here during the COVID sell-off in February, March of 2020. And this takes us again to the end of August, beginning of September of 2021. And you can see here positive, very short negative signal, and then a nice long positive signal. And again, just like with the risk signal, I'm stopping the data at the end of August. And if you want the most current information, please become a subscriber. Now let's go back and take a look at how simple market signals could have helped you in the bear market that started in 2000, that ended in 03. And then next we'll take a look at the bear market that started in 2007, that ended in 09. So in 2000, you can see that the risk signal, the market mode signal, would have turned red right here at approximately 1450 on the S&P 500. And this risk signal, the market mode signal, would have been red through the majority of this downturn. and then turned green right here just under 900 on the S&P 500. So think about that. Any of you that lived through this, any of you that were invested in the stock market during this period of time, as I was, right? I was working for Oppenheimer Funds, the mutual fund company, during this time. But you can see here, guys, this huge drawdown, right? This hurts, and it lasted for several years, and it just felt like every time we were starting to pull out of this, something would happen that would send us lower. All right. And these types of downturns, these prolonged downturns that last years, they are brutal. But think about how much knowledge you'll have when the risk signal is red whenever we get to the next bear market, right? Whether it lasts a few months or a few years, when you know that that risk signal is red, you know what to expect, right? Losses are much more likely than gains, and so you can take the proper measures to protect yourself, and you'll have realistic expectations as to what is probably going to happen. But then when that risk signal turns green, you know that the likelihood of you making money has substantially increased. Okay? Now let's take a look at the bear market from 07 that ended in 09, and you can see here that the risk signal would have turned red right here, right around 1500 on the S&P 500. And you can see that the risk signal would have been red for the majority of the downturn. We did have one short green signal right here that lasted 1 week, and then the market rolled back over. And so maybe you would have had a small loss here, okay? But that's just the way any type of protective system works, guys. But think about this. Again, you could have got out, or went to cash or done whatever you wanted to do right around 1500 to protect your portfolio, and you would have had a green signal that would have came out around 875 on the S&P 500 right here in 2009. So 2 of these types of downturns in the course of a decade, and simple market signals could have helped you really protect yourself and really understand what was going on in the market and set realistic expectations for you in both cases. And when the risk signal turns green, as it did right here, you will know that the likelihood of you making money in equities has substantially increased. Why is simple market signals so important? Because market risk is the single biggest risk most investors face. And market risk is non-diversifiable risk. Market risk cannot be diversified away. And future investing success will require getting in sync and staying in sync with the stock market by using stock market-driven data. Simple Market Signals is built around a multi-factor stock market-based model. I'm going to repeat that. Simple Market Signals is built around, based on, a multi-factor stock market-based model. Simple Market Signals identifies the current level of market risk, giving you the opportunity to stay in sync with the stock market. Now let me share with you what subscribers are saying about Simple Market Signals. First, we are going to hear from KT from Michigan. I have been trading for many years. I did not realize that I have been trading in a completely blind fashion. SMS has given me the direction, literally, I've been desperately needing. This service allows you to clearly see what the market is doing. If you are remotely serious about trading or investing, you must try this service. Again, that's from KT from Michigan. KT, thank you. I appreciate that feedback. Next, we're going to hear from SC from Florida. And SC writes, I manage my own money and I am not a professional, which could lead to a disastrous outcome as it has for many. Simple Market Signals is the equivalent of having a personal money manager that keeps you invested when it counts and alerts you to the potential dangers ahead. Now, I want to point out here, guys, I used to be a money manager. I sold my practice in 2016. So these are the exact words that SC from Florida wrote to me. So I just printed it as is. But I want you to understand, I cannot give advice, but this is the feedback that SC from Florida gave me. So I appreciate this. So again, SC writes that Simple Market Signals helps you stay invested when it counts and alerts you to the potential dangers ahead. The service is extremely affordable and takes the uncertainty and fear out of being in control of your own investments. I have done very well using this system and consider myself lucky that Rodney's YouTube channel came into view one day. I highly recommend this to anyone who desires an easy system to produce positive returns in the markets. Again, that's from SC from Florida, sent from his iPad. And guys, I want to point out the reason I'm using just the first and last initials is for the security of my subscribers, okay? I have hedge fund managers, very well off, multi-millionaire clients. I have, people that are high up in various areas of the government. I have people from all walks of life. So just out of respect and security for my clients, this is the way that I'm presenting the information, just with their first and last initials as well as their state. Next, we're going to hear from FS from Massachusetts. Rodney is spot on in his reading of the markets. I was looking for a heads up to help me choose which side to use for vertical spreads. Again, that's from FS from Mass, and thank you so much, FS. I appreciate that. Next, we're going to hear from JV from New York. Now, I posed a few questions to my subscribers a few weeks ago, and this is the feedback exactly that JV from New York gave me with respect to the question. So I produced it just as he wrote it. So the first question, what do you like best about simple market signals? What JV said was, one of the things I like best about simple market signals is that I have an easy-to-use tool at my disposal. I use the green, yellow, and red signals along with the general trend to help me determine how much equity risk exposure I want my investments to have in the market at any one time. I will either increase or decrease my equity exposure based on those metrics. The next question, what is important about simple market signals to you? JV writes, I am a conservative investor. My main goal is to preserve as much capital as possible during market downturns, yellow and red signals, and to optimize my returns during green light conditions. The next question, how has simple market signals helped you? JV writes, SMS helps me to determine whether to stay the course, increase equity exposure, or take defensive positions. For example, I will add additional funds to my equity investments during green conditions and move money to cash during red conditions. And the last question, how have you benefited from simple market signals? JV writes, one of the benefits of SMS is that it has reduced the stress from always looking at and analyzing market conditions and worrying about it on a daily basis. And again, this is from JV from New York. JV, thank you so much for the feedback. I really appreciate that. The signals are delivered to subscribers in our weekly video newsletter. In the weekly video newsletter, you will get weekly updates on our proprietary market mode signal. That's our risk level signal. And of course, you'll also get the updated chart for that signal each week. You will also receive the proprietary market mode risk level signal on all 11 major sectors of the S&P 500. You will also receive a weekly update on our proprietary general trend indicator signal, and of course, the updated chart for that. You will also receive market analysis on over a dozen charts every week covering all major areas of the stock market, including several international charts. So I'm going to cover small, mid, large. We're going to cover both a growth and a value ETF. I mean, guys, this is going to help you understand what's going on across the board. Of course, several charts every week on the S&P 500. We'll cover the Dow. We'll cover the triple Qs. So we're going to cover pretty much everything in there, okay? And so this is going to give you a really solid base every week as to what's going on in the stock market over and above our proprietary information that we're sharing with you. And then depending on what's going on, there will be occasional bonus material, not necessarily every week, but occasional bonus material, and this will be anything additional. Sometimes we look at the WTIC, which is the West Texas Intermediate Crude Oil pricing. We'll look at various charts on that. We'll look at the US dollar. Again, this, from week to week, these things will vary, but these will be important and timely things that I feel that you guys need to know at the time that the information is delivered. Okay, so that'll be the occasional bonus material when applicable. You will also have access to best practice videos for the successful implementation of everything related to simple market signals. So the market mode, the risk signals, you'll have educational videos on that. You'll have educational videos around the general trend indicator to help you fully understand how to use them and what are the options that you may want to employ And you will also have best practice educational videos for tips on successful investing. And this is over and above anything related to simple market signals. And guys, this is going to be extremely valuable to you. And this video library will continue to expand over time. The signals are updated each weekend in our weekly video newsletter. The weekly video newsletter is generally ready by Saturday at 6 p.m. Eastern Standard Time each week. However, depending on our production schedule, the weekly video newsletter could be finished and ready for you to view anytime over the weekend, right? If we can get it out earlier, we will. And if there are any major signal changes in the middle of the week, we're not going to wait until the weekend to get you that information. We will post a new video mid-week with the new updated information. If there are any major signal changes to either the risk signal for the overall market or to the general trend indicator. Now, if a signal changes on one of the sectors, we generally do not post a midweek update on that, all right? We reserve the midweek updates for the major signals, and then each weekend, of course, you will get the updates on the sectors as well as all other information. And you will have easy, convenient access to this information. Everything is on YouTube in the members area of the channel, and everything is in video format. There's no emails to mess with and no websites to log into other than, of course, YouTube. To be fair to myself, I should be charging $97 per month or more for this information. However, you're going to get everything for just $19.99 per month. That's less than 67 cents per day. And to become a member of the channel and get access to the Simple Market Signals information, you will need to go to the Rodney E. Constable Stock Market channel. So depending on how you found the video, you may or may not be there, but you need to make sure that you go to the Rodney E. Constable Stock Market channel, and then you're going to click on this join button. Now, if you're not signed into YouTube, you will need to sign into YouTube, okay? So you'll need to sign in. All right, and then once you're signed in, then you'll see this box pop up, right? Get access to exclusive perks when you become a member. So you click on the join button, and you will see the information here, what you're going to get with your subscription, of course, your membership. And then you click on the join button, and you want to add your credit card information. So as you can see here, you can pay with either a credit or debit card. Enter your card number, of course, the month and year of expiration, security code, cardholder name, and your billing zip code. So I'm going to fill all of this information in, and I will be right back. So once you hit that buy button, which is in the lower right-hand corner of that box, that previous box, you will then get this pop-up. Welcome. It's great to have you as a member. So then you can click on the See Perks. So once you fill all that out and your membership is established, then you will have access to the membership area where you will be able to see the perks, right? And then you go over to the community tab, and this is where you will have access to the various videos, and you just click on those and it'll pull those up, okay? So I'm going to back up here, and so this is where all the training videos will be, as well as the weekly updates to the Simple Market Signals that will be under the community tab. And that's all it takes to become a member. It's quite simple. So just to review the membership details, the video membership to Simple Market Signals through YouTube is $19.99 per month. That's less than 67 cents per day, and it's billed monthly on your credit card, or you can pay with PayPal. There are no contracts. You can cancel anytime, and if you do cancel, your membership will remain active for the balance of that current month, right, for that prepaid period, but you won't be billed for the next month. All memberships are controlled by YouTube, so if you ever have any question about anything, just Google it, and the answers should be out there. Some of my clients tell me they make tens of thousands of dollars per year from the information they learned from being a client of Simple Market Signals. It's not often you have the opportunity to invest a few $100s per year in yourself and potentially pull out thousands or tens of thousands of dollars per year from that tiny investment. This year, give yourself the gift of financial knowledge that can bring you big rewards over your lifetime. Now let's recap what you will get as a member. As a member, you will receive the weekly video newsletter, which includes the weekly update on the proprietary market mode, also known as risk signal, on the overall U.S. stock market. You will also receive the weekly update on the proprietary market mode or risk signals on all 11 major sectors of the S&P 500. You will also receive the weekly update on the proprietary positive negative signal for the general trend indicator. You will also receive weekly market analysis on the overall market, and there's generally 12 plus and sometimes more than 20, right, depending on what the information I need to disseminate, but there's generally at least 12 plus charts every weekend covering all major areas, right? Small, medium, large, growth value, all of that, including several international charts. But all of this is over and above the proprietary risk signals. So the weekly market analysis alone, guys, is worth far more than the $19.99 a month that we're talking about here, okay? Plus, you will receive occasional bonus charts as deemed necessary and appropriate for whatever's going on in the markets, all right? So that's bonus material that I do throw in from time to time, and that can be extremely valuable to you. Plus, you will receive special midweek updates when warranted. So again, if there's something going on in the markets, if there's a signal change in the middle of the week, we will put out a midweek update video so that you can stay current on the information. We'll get that out as fast as necessary, okay? And you'll also receive access to the growing video library of best practice educational videos that are part of your membership, and that will continue to grow over time, all right? Again, you're going to get all of this for just $19.99 per month. That's less than 67 cents per day. And to become a member of the channel and get access to the Simple Market Signals information, you will need to go to the Rodney E. Constable Stock Market channel. So depending on how you found the video, you may or may not be there, but you need to make sure that you go to the Rodney E. Constable Stock Market channel, and then you're going to click on this join button. Now, if you're not signed into YouTube, you will need to sign into YouTube, okay? So you'll need to sign in. All right, and then once you're signed in, then you'll see this box pop up, right? Get access to exclusive perks when you become a member. So you click on the join button, and you will see the information here, what you're going to get with your subscription, of course, your membership. And then you click on the join button, and you want to add your credit card information. So as you can see here, you can pay with either a credit or debit card. Enter your card number, of course, the month and year of expiration, security code, cardholder name, and your billing zip code. So I'm going to fill all of this information in, and I will be right back. So once you hit that buy button, which is in the lower right-hand corner of that box, that previous box, you will then get this pop-up. Welcome. It's great to have you as a member. So then you can click on the See Perks. So once you fill all that out and your membership is established, then you will have access to the membership area where you will be able to see the perks, right? And then you go over to the community tab, and this is where you will have access to the various videos, and you just click on those and it'll pull those up, okay? So I'm going to back up here, and so this is where all the training videos will be, as well as the weekly updates to the Simple Market Signals that will be under the community tab. And that's all it takes to become a member. It's quite simple. So guys, the way I see it, I am basically giving you a roadmap to free money in the stock market. Now, it's up to you to use this roadmap to extract this free money from the market. This free money I am speaking of could be in the form of either additional profits that you otherwise would not have gained based on the difference between what you were doing now and what you could do with the additional information you learned through Simple Market Signals, or the free money I am referring to could be in the form of captured profits that you otherwise would have given back to the market in the form of losses. So think about this. Again, this is the way I see it, guys. I see it in my head. I know how valuable this is. Right? So I'm giving you a roadmap. You have to employ the information yourself, but I'm giving you a roadmap to potentially free money in the stock market. So join now to start benefiting immediately from this valuable and potentially life-changing information.